the SWIFT banking system began to be weaponized to further the political interests of the United States government overseas, other central banks felt themselves left with no choice other than to look for a store of value and a medium of exchange that was outside of the control of the U.S. government. The easiest place to go was gold. Many people say, well, why don't they just trade with each other in their own currencies? There's an easy answer to that. As little as they trust us, they trust each other less. The U.S. dollar, laughingly, is the worst currency in the world, with the sole exception of every other currency. The strength that you have seen in gold has been almost entirely foreign central banks buying gold because they don't have any other alternatives. I think you could see sharply higher gold prices.
RickRule of Rule Investment Media highlights how foreign central banks, lacking viable alternatives to the U.S. dollar, have increasingly turned to gold as a hedge against US-centric financial systems. Despite economic sanctions targeting various sectors, the gold market remains unaffected, mainly emerging as a haven amidst geopolitical turmoil. Following Russia's invasion of Ukraine, significant actions such as the United Kingdom's cessation of Russian gold imports underscore the evolving dynamics of the global gold trade. U.S. Treasury Secretary Janet Yellen's confirmation regarding the White House's imposition of sanctions on other nations has led to shifts in international relations, with Brics and other countries opting to reduce reliance on the dollar. Russia's ascendance as the world's second-largest gold producer and projections of continued production growth further underscore the country's strategic position in the global gold market. RickRule predicts that this surge in central bank buying and heightened investor awareness of currency depreciation could propel gold prices to unprecedented levels. A recent report from Goldman Sachs corroborates this view, highlighting the influence of new incremental factors, including increased central bank accumulation in emerging markets and heightened retail buying in Asian markets like India, in driving up gold prices globally. RickRule emphasizes that the recent upsurge in gold prices is not solely attributable to retail investors' concerns about purchasing power erosion, but is also driven by broader geopolitical and economic factors. With bullion trading near record highs, exacerbated by escalating tensions in the Middle East, the appeal of gold as a haven investment continues to strengthen. Come along as we explore the valuable insights provided by RickRule. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
Gold's done its job. People have asked me for years, when's gold going to move? And I say, 2000. Price of gold in 2000 was $253, $254 an ounce. And it moved up to sort of $1,900 an ounce. So that's what, 8.6, 8.7% compounded for 22 years. If you're asking for a commodity that, as a savings instrument, could shield you against inflation, if you look at when gold was going to move at the beginning of the century, it did move. The move has accelerated, and it has excited people. To me, the move that we've seen so far is a non-event, really. I think it's a flow of funds issue. I don't own gold because I think it might go to 2,400 or 2,200 or whatever the number is. I own it because I'm afraid of the possibility, not the probability, but the possibility that it goes to $7,000 or $8,000 or $9,000. That's not very far-fetched. In the decade 2000 to 2010, admittedly it took 10 years, the gold price went up sevenfold. It doesn't seem like too much to ask, given the deterioration in the purchasing power around fiat instruments, for the gold price to triple. I frankly hope it doesn't, but I sort of think it will. Let's examine, James, the recent strength in the gold price. This didn't happen because retail investors were concerned, expressing concerns about the deterioration of their purchasing power. It didn't happen for traditional reasons. It happened because the U.S. government weaponized the U.S. dollar. They confiscated $300 billion worth of Russian holdings of U.S. Treasury securities. That made other countries who don't necessarily favor policies that are attractive to the U.S. government concerned about their own holdings of U.S. Treasury securities. The second thing that the U.S. did is they weaponized the SWIFT banking system. The SWIFT banking system is supposed to be an international settlements mechanism, using the U.S. dollar as the reserve currency. It is not the property of the United States. But when the SWIFT banking system began to be weaponized to further the political interests of the United States government overseas, Other central banks felt themselves left with no choice other than to look for a store of value and a medium of exchange that was outside of the control of the US government. The easiest place to go was gold. Many people say, well, why don't they just trade with each other in their own currencies? There's an easy answer to that. As little as they trust us, they trust each other less. The US dollar, laughingly, is the worst currency in the world, with the sole exception of every other currency. The Chinese don't want 1 trillion rubles. And what that means is that in order for Iran to trade with China, China to trade with Russia, Russia to trade with Brazil, they need a medium of exchange outside the US dollar. And the strength that you have seen in gold has been almost entirely foreign central banks buying gold because they don't have any other alternatives. If you lay on top of that the realization on the part of investors that their own purchasing power is degraded by holding fiat currencies, I think you could see sharply higher gold prices.
Despite gold reaching record highs, investors are reluctant to cash in on their profits and show a growing interest in acquiring more precious metals. RickRule notes a notable shift in sentiment despite recent trends indicating retail investors as sellers in physical gold ETFs. Over the past 12 to 13 days, there has been a reversal with inflows into ETFs, indicating a renewed appetite for gold among investors. Recent robust inflation data prompted a rally in the dollar and 10-year Treasury yields, raising doubts about the Federal Reserve's potential June rate cut. In a typical market scenario, such developments would lead to a sharp correction in gold prices. However, despite an initial $30 drop in response to the inflation data, gold quickly rebounded even as the dollar and yields continued to rise. This resilience suggests that gold buyers eagerly capitalize on any price dips. Rule highlights that gold is perceived as a competitor to instruments like US Treasuries, which offer returns that may not keep pace with inflation. This makes gold more appealing as a hedge against wealth erosion over time. Let's get back to the interview.
The middle part of that move, 2002 to 2006, I think was a lot about the perception of the end of U.S. hegemony, continuously lower interest rates, both real and nominal, and a continued weakness in the hegemony of the U.S. dollar. I think it was all about that. There was also a form of inflation that wasn't felt throughout the economy, but there was raw material inflation. While the price of consumer goods fell through the decade as a consequence of advances in technology and productivity, the price of basic commodities, fueled, I would suspect, largely by Chinese demand, was very, very strong. And I think that some of the luster that gold enjoyed during that decade was reflected luster from other parts of the commodities complex. But I need to say, I'm not an economist. I'm really, truly out on a limb here. I'd be leery about describing the whole causation. I just wanted to point to that event to put the possibilities of this market in context. Until 12 days ago, if you measure retail interest by the physical gold ETFs, retail investors have been sellers. They haven't been complacent at all. They've been bearish. They've been selling. The psychological impetus that the markets got from gold breaking out to at least nominal as opposed to real highs has been such that the last 12 or 13 days have seen inflows into the ETFs. But before 2 weeks ago, it isn't as though the retail investor was neutral. The retail investor, as expressed by data, was bearish. I think that changes. I really, truly think it changes. If you consider the biggest enemy of gold to be the U.S. 10-year Treasury, the ultimate fiat instrument, let's think about the arithmetic around the U.S. 10-year Treasury. The U.S. government promises to pay, and they will, even if they have to print, you 4.2 or 4.3% per year on your savings in a currency where the depreciation of the purchasing power is 7%, which means that the U.S. government in actuality is promising to make you poorer by 2.5% a year compounded for 10 years. I think they'll keep that promise, but it's not a very attractive one. So I would suggest to you that ultimately in the psyche of investors, gold's competition is an instrument which promises to make you 2.5% a year poorer for 10 years. I think gold can stand up to that fight.
Gold has the most impressive recent market performance. Currently, no one can stop the rapid rise in gold prices. Do you agree with his assessment of gold's resilience amidst geopolitical turmoil and its role as a hedge against currency depreciation? Share your perspective in the comments below. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.